of all, tell us, do you believe that ULIPs or unit-linked insurance plans as a product are not really understood or clearly understood by most investors? Sometimes they're even confused with traditional endowment plans. What do you think?
Uh, yes, I think to some extent what you're saying is true. I mean, ULIPs are relatively, I would say, complex as compared to other savings that are available in the form of debt and equity instruments. Especially in the unit-linked insurance plans, we are selling, savings along with the insurance, and even the insurance also. If you look at the cost of insurance, varies for a person to person, smoker to non-smoker, and also for the different age groups, the cost of insurance will be different. Overall, because of this, in the insurance product itself appears to be relatively more complex than the normal traditional plain vanilla savings instrument. That's one. And but over the years, I would say that insurance companies have taken many steps to simplify the product structure, and even the whatever the charges that are there in the various ULIP products has been simplified a lot. But still, I think having said that, it's a combination of savings plus insurance product. And also insurance, varies between person to person. Overall, the cost structure is slightly going to be different, and it will take, it is in that sense a little bit complex. Having said that, and when it comes to the traditional endowment plans, I think those things are completely different. I think investors do understand the difference between the traditional endowments and ULIPs. Yeah, vis-a-vis other the savings alternatives that are available. ULIPs are somewhat, I think, difficult to understand, and they're a little bit product specific. It's not just the typically an investor in the equity market or a fixed income market, they just go by the funds and fund statistics alone. But here, when you look at the ULIPs, there is something like a product attached to it. There's nothing like a product you see in the the mutual fund space or any other savings avenues that are there. Here, you have to the product actually talks about various expenses that are charged, to the to the fund or to the customer. So one has to go through that in detail. All the details are there certainly in the product and the product illustration. But into the it takes a bit of time for people to understand and go through that. To that extent, yes, ULIPs are somewhat not very well understood by most of the investors, and rather it would take a little bit of a time for them to go through and understand the cost structure that are there in different ULIPs.
How is ULIP as a concept perceived in India, and how do you look at them as a product which can really create wealth for long-term investors?
Pallavi, I think from a ULIP standpoint, like Mr. Sampath said, it is lesser understood because it's relatively more complex. Point one, I agree with that statement. Point two, I think it is in India bought from a taxation standpoint during the months of Jan, Feb, March, when you have to actually save the tax, which I think is not the right thing to do. Most people actually rush to buy it. So complex product with a rush to buy is a bad combination. So that's what I understand how it's happened this so far. But I think the industry is evolving. Cost structures are becoming more attractive. Any investment product will have its merits and demerits. If you can capitalize on the merit of the platform you're using for your savings, then it will be advantageous. For example, the tax advantage of the return, for example, on the ULIP side, in spite of this being capped in this budget to 2.5 lakh premium per annum, which is a reasonable amount, still exists. Switches are easy to do between equity and debt, and you don't get taxed. So point I'm trying to make is every platform will have its advantages. If you're not able to capitalize on those advantages, don't use that platform.
Okay, sure. In fact, Mr. Reddy, as we're talking about how ULIPs have evolved, I want you to make us and our viewers understand how ULIPs have evolved in terms of the cost, in terms of the returns, and in terms of the positioning also.
Right. Yes, I think in the initial years when the private life insurance industry, got opened up, during those times, the cost structures was quite, I think, relatively high as compared to any other savings industry. And after the 2010, the regulations have brought in, the maximum, the expense ratio that you can charge to the, funds over a period of, time. So that has basically, set the, tone for the overall reduction in the cost structure. And over the years, in fact, the industry, life insurance industry has moved ahead and, in fact, come out with products which are, I would say, as, cost effective as one of the best in the industry. Let's say even, you can compare some of the life insurance industry's cost structure similar to that of, or even better than some of the, the direct plans of, mutual fund industry. So we are on par with, pretty much one of the, lowest costs that are there for the investors to save in equity and fixed income markets. And to talk about, for instance, our own product, which is, the Goal Assure, where we are offering to the customers only FMC charge of 1.35%. We're charging that's only 1.35% FMC, and also even returning the mortality charges to the customers. So which means the total expense ratio in the true sense, if you were to compare with the similar savings platforms that are there, is just going to be only about 1.35% plus of course taxes. Even the mortality charges which are being charged will be returned to the customers upon the maturity of the product. So you are actually getting the insurance cost free, and your savings are cost structure in terms of expense ratio on your savings side of the pool is pretty much on par with the direct plans of the mutual fund industry. So I think there's been a significant change in terms of the way that ULIPs have been there over the years.
Mr. Reddy, if I talk about the different features, and we are of course focusing on the dual feature that comes with ULIPs, the insurance and investments, could you tell us how this feature can really benefit the investors?
Obviously, the insurance brings in its own, advantage. A lot of people in India require, insurance, given that kind of income levels, and given that, the dependency of the family and the breadwinner. So that brings the certain, clearly the benefit of insurance. And also, it is not very well understood the cost of insurance in the ULIP, to the customer. Because at the time of at the beginning, in the first year when you pay the premium, the mortality charges appears relatively higher. But as you move ahead in terms of with your premium paying in second year and third year, overall the cost of insurance actually comes down. So the way that because the overall the market value of the fund itself, that along with your one is with the appreciation, other is with your contribution increasing, all of that taking together, the cost of insurance actually will keep coming down as you move ahead. So this particular aspect is not very well understood. Okay, they look at only the first year, the charges in terms of mortality, and it appears to be quite high. But as you move ahead, the cost of insurance actually comes down dramatically. 6-7 years down the line, there may not be any charges debited towards mortality, for a longer term ULIP. Okay. So these things are not very well understood by the investors. I think that's
right. Since we are also talking about the other kind of products which are available, Mr. Reddy, I want you to help us understand how ULIPs fare compared to non-participating plans, especially when you're talking about the current economic recovery.
Yeah, non-participating funds are actually picked up a lot in terms of as a percentage of the new business that we are doing across the life insurance industry. Non-participating funds are actually the ones which are giving you the guaranteed investment, so that guaranteed return. So because of the volatility that that we had seen in the last financial year in terms of equity markets, volatility and significant sell-off during the times of COVID, I think since then the investors' appetite as towards the non-par products have improved tremendously, and the life insurance industry is uniquely positioned today to offer the guaranteed returns of to some extent the current good interest rate environment, taking that into the queue, we can offer, the better returns to the customers, which are prevailing today, even in the future premium that the customer is going to pay. So, that's the, normally if you go to any other savings, product, whether it's a bank deposit or any other alternative fixed income savings platforms that are available, whatever is the interest rate today that is there, you will be able to save, invest at that rate which is available. But when you get the, say when your savings pool increases in the next year, if you wanted to put that money also, you will be basically investing at that money depending on whatever is the interest rate then prevailing. If interest rates are going to come down over the period of time, you do not have an opportunity to save based, your future incomes as well at the current, somewhat, closer to the current high interest environment. That's what is actually, the non-par products are, coming into the play. So even, over if a customer is paying a premium over a period of 5 years or 10 years, even on those premiums which are going to come in the future years, his investment return is guaranteed. So to that extent, these products are picking up a lot in the life insurance industry today. And because life insurance industry can hedge these through some of the derivatives that are available in the market, we are able to offer this to the customers. So I think the non-par industry for the life insurance industry is doing very well.
So coming to the risk part of investment planning, Mr. Reddy, do ULIPs carry high risk as compared to the equity mutual funds? How do you explain us in terms of the risk factor involved?
Yeah, I think there are different funds which are in the ULIP. Like for example, typically any particular ULIP could normally be offering to the customers a large cap equity fund, or a mid cap equity fund, or a small cap equity fund, or a balanced fund, or a debt fund and a liquid fund, which is what we do offer. So obviously the risk factor for each of these underlying funds will be different for different funds. And largely, I would think that the equity fund of a large cap equity fund typically would have risk profile similar to that of a large cap equity mutual fund, and mid cap equity fund of ULIP would have it similar risk profile that of the mid cap mutual fund, like so on and so forth. So I would not say that the risk profile is any different from that of mutual fund industry, especially when you compare it to the fund level, mandate to mandate level.
Okay. Feroze, anything you want to add?
Yes, I think risk is a word which can be numerically measured, fortunately. And I think numbers suggest that on the risk parameter, they're not too different. For example, a large cap equity mutual fund has a 14 risk number, which is called the 14 standard. The standard deviation is 14. So if you compare it with a large cap portfolio created on the insurance platform, it would be close to that. So that's one. But the second thing, which when it comes to insurance actual portfolio performance, since they have so much time in hand, they're not scrutinized on a very consistent basis. Most ULIP owners, of course, would not even know whether their respective portfolio has beaten the benchmark, and where does it fare across the several portfolio managers which are there in the industry. And the attention is on cost. And if you speak to an insurance agent, the first thing he speaks is cost. Cost is value minus cost is what you take home. The focus is cost. Unless it becomes value, the industry will not actually capitalize on the value creation which it can do as a wealth generating platform. So I think that's where we are not, because of a closed-ended nature, there is certain degree of agility which is missing, which I think is something I'm sure will get addressed over years to come.
Also talking about the asset allocation which comes with ULIPs, Mr. Reddy, tell us what portion do ULIPs, in general invest in the debts, and how does that help in building a long-term portfolio?
Yeah, so the asset allocation is not something handled at the fund level. It is largely handled by the investor himself by choosing different funds based on his risk appetite. As I mentioned, like any particular ULIP would normally be having diversified investment products like large cap equity, mid cap equity, small cap equity, the bond fund and liquid fund and balanced fund, etc. So underlying investor will choose his appropriate fund that is suitable for based on his risk appetite. Like for example, investors with relatively closer to the maturity may move some of their funds into the fixed income fund, and in the most while staying invested in the equity funds for the long period of time in the initial period when he's saving with us. So these kind of asset allocation will be planned by the customer himself. And apart from that, as Feroze mentioned in his in some of his points, that the customers have the flexibility of choosing the different funds. They can switch between different funds any number of times, without having any taxation issue or without having any transactional cost issue while switching. So that with that tool available to the ULIP investors, they can plan their own asset allocation. If you think that markets are overvalued, you can move some of your money into the debt fund or a liquid fund. Or if you think that you've been saving with us for the last 10 years and the remaining 5 years are left, and if you have made substantial amount of returns on your equity platform, you can move some of it to the fixed income side, giving that your remaining term for the with us is relatively smaller. So those kind of asset allocation decisions can be taken by the customer itself. But as I said, like we particularly offer different styles of savings so that the customer can choose the right allocation for itself.
Sure. Mr. Reddy, since we are almost approaching the end of the session, I want you to summarize the biggest benefits which are offered by ULIPs as compared to other investment avenues. Some of it we've already addressed, but if you are to summarize it.
Yeah. ULIPs offer very good savings and investment vehicle for the investors, and the cost of insurance slightly, I would think, is misunderstood. As the customers stay for a long period of time, 10 years and 15 years and so on, the overall cost of insurance will be relatively small and negligible. And there is a significant, I would say there's the switching benefit that insurance companies offer is also quite attractive to the customers. And moreover, the life insurance industry and ULIPs actually backed by a very good investment team, and they offer one of the attractive investment propositions that are available in the country, from an equity and fixed income platforms as such. So I would think the cost element earlier, which was misunderstood, is now earlier which were high, is now brought down, and they do offer one of the best investment vehicles to the customers now.
Mr. Reddy, any last piece of advice for the investors?
I mean, so ULIPs are typically the longer term savings plan, with a minimum investment horizon of 5 years. And if the customers, do not, have that kind of a horizon, it is, I would think, it's not advisable. And especially, the customers who are saving for a really longer term, 5 years and 10 years and so on, the cost structure is very, very attractive. And, as Feroze was saying that, from a longer term perspective, equities do offer a very, very attractive proposition given the inflation that is going to be there in the economy. So, with that, you should have a longer term orientation look at the ULIPs, because, the cost structures are such that, as you stay for a longer period of time, overall, your costs will be lower. Of course, given that your costs have come down dramatically, what makes the difference is, in terms of, the good performance that a fund can offer, which and also, of course, the best return that one could generate. That makes the significant impact and factor than the cost anymore. So stay invested for a longer period of time.
So we learned a lot about ULIPs as an instrument and newer aspects of this particular product. Thanks a lot, both of you, for sparing time and discussing ULIPs. Thanks a lot, Mr. Reddy. Thank you for being part of the session.
Thank you.